Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis. Hey everybody.
Hey Lauren, this is a recent article of the Wall Street Journal, and the lead of it is investing based on economic forecasts. Forecasts can lead you astray.
That's okay. Right, it certainly can.
And the reason I bring this up is almost every new client or prospective client that I'm working with, in their planning, when we're talking about risk allocation and how much risk to take in their portfolio,
right?
Probably the first question that they ask me is, what do you think is going to happen, in the future or the near future? What's going on with interest rates? Is this a good time to invest in bonds or stocks? What's going on in Europe or the deficit? Whatever the reason is, is this a good time to invest?
Right.
And before we talk about why that's not a good idea, this is concrete proof is. The so-called experts, they did this is going back just to last year, to 2014. They had 46 economists surveyed by the Wall Street Journal about what their forecast was for interest rates for just the 2014 year.
Oh dear. All right.
45 out of the 46 got it wrong, 100% wrong, and the 46 predicted it to be flat, yet it actually went down. The yield went down the 10-year bond. Anyway, the long story short is they're all wrong.
Yeah. Okay. Nobody thought interest rates would go down.
Right.
Nobody thought that.
Right.
Well, I guess one person did.
And everybody else, but he thought it was going to go flat.
Oh, so there was one. Everybody else thought it was going to go up.
Exactly.
Right. So there's one person who was not totally wrong.
And the takeaway from that is if an investor totally got out of bonds, let's say, and went to cash,
right, that
would not be, they left money on the table.
Yep.
And then, but the kind of a more important thing is, it's been proven time after time that if you try to invest based on economic forecasts, it's a recipe for failure.
Yes. And
also, so some of their things, this is I think the most important question is, when you're looking at it, making a decision based on a forecast, this is a great question. Do you have any evidence that this forecast hasn't already been priced into the market?
Right. That's exactly right.
I love that question.
Yeah. And just to hang on that question for just a little
Sure.
bit, what we mean by that is that if the economy is an 8 on a scale of 1 to 10, but everybody thought it was going to be a 9, your stock returns are going to be lower than average.
Right.
If the economy is a 3 on a scale of 1 to 10, but everybody thought it was going to be a 2, your returns will be better than average. So even if you get the forecast right, you're not necessarily going to get even if you get the economic forecast right, you're not going to get the investment forecast right unless you somehow also know what everybody else thinks is going to happen. And that's where people really make mistakes, because people will think, well, I knew that we were going to have high unemployment for a long time.
Right.
Yep, we had high unemployment for a long time and the stock markets went up.
That's right, exactly. And then kind of in this episode, the second question, which I really like, which just totally resonates with what you just said, is, do you want to make changes in your portfolio based on this forecast, even though you know the herd is making these changes? And following the herd typically ends badly.
Right. Yes, that's exactly right.
And the herd last year was saying, do not invest in foreign stocks. Of course, the herd was wrong, because this year the foreign stocks are doing better. Now the herd is moving towards foreign stocks. So
it's always the same.
All right. So anyway, the final thing is. It's okay to look at economic forecasts, but don't make your investment decisions based on that. All right. Thank you for watching this episode of Erickson TV, and we'll see you next time. Bye now.
See you next time.